Hello, everyone, and welcome to this webinar. I'm delighted now to introduce you to Antonio Fatas, a professor of economics at INSEAD. He's also the Portuguese Council Chair Professor of European Studies at the school. So Antonio, as you probably know, has a very lengthy CV and a sizable stack of published research, but he's asked me to get down to business as quickly as possible so he can talk to you about the world economy in 2022 and also answer your questions. We'll do this webinar in two parts. So I'll jump in about halfway through and ask him some of the questions that you might be asking. So feel free to put those in the Q&A and upvote those you're most interested in. So Antonio, over to you, please.
Thank you, Chris, and thank you everyone for coming, and good morning or good afternoon or good evening, depending on where you are. It's a pleasure to be here again, trying to figure out what is happening to the world economy as we speak in 2022. Now, we've been running this same webinar for the last 3 years, partly because we're all now at home doing things like this, but also because of the COVID crisis. I think opened lots of questions for all of us, and we're all trying to understand better what the global economy was going to do. Now, what I did before starting preparing my slides for this year, I thought, let me look at what I did last year and see what are the things that I got right and what are the things that I got wrong. Now, let me just list some of them. Of course, I'm the judge. So as you can see, I left a lot of space for the things that I got right and very little for the things that I got wrong. So these are the things that I sort of emphasized a year ago that seem to be validated over the 12 months that follow. So we've gone through a V-shaped recovery. That's a little bit the spirit of what I was referring to a year ago, a very fast recovery. We've seen the stock market doing quite well. One thing that I emphasized when I was talking about the state of the stock market a year ago is that the fundamentals still look quite solid, even if we're talking a lot about overvaluation and the stock market being detached from the economy. But the stock market has done quite well, even despite the decrease in the indices over the last weeks. You still have a return over the last year of about 18% since we had a seminar a year ago. Now, government debt, I said, is not an immediate risk. And in the last year, we have not had a lot of tensions when it comes to government debt. And something else that I discussed briefly as well a year ago, I talked about sort of cryptocurrencies versus new payments. My prediction was cryptocurrencies would not become a mean of payments over the last year, which they haven't. But at the same time, we are going to see a lot of innovations on new payments that we have seen, both on the side of the private sector, but also on the public sector with the launch of some central bank digital currencies. Now, there's something that I got wrong, which is my view on inflation was a little bit sort of underwhelming, in the sense that I thought inflation would not be a big issue. And inflation is on the headlines of every media today when they talk about the economy. Now, I thought there would be a tension when it comes to inflation. I could not imagine inflation going as high as it is today at the end of last year or at the beginning of this year. Now, I'm going to start, in fact, there. I'm going to start a little bit with what is it that has been the biggest surprise and how does that help us understand where we are today. Now, let me show you some data. If you look at the world growth over the last 20 plus years, you see two very clear recessions, one in 2008 and 9, one in 2020. Now, what I want you to do is the following. Try to think about a line like the one I'm drawing, that is sort of the growth rate before the crisis. So I just drew a line for the global financial crisis. That's sort of the average growth rate the years before the crisis. Now look at the recovery, 2010, 2011. Now, obviously, we're jumping up, the growth goes up, but at no point in time you see a significant period of above growth rate, growth of the pre-crisis years. So you see a growth rate which is similar in 2010, then much lower in the years that follow. So we're bouncing back, but we're not bouncing back in a way which is dramatic relative to the pre-crisis growth. Now, if you look at last year and what we expect for this year, 2022, which is in light blue, we see growth rates which are clearly higher than what we had before the pandemic. Now, you might say that's normal because we need to bounce back. But you can see the comparison with 2008. It is not what happened in 2008. Now, let me give you the same story with pictures that are probably going to be a lot more clear. Let me give you a measure of the following. How close are we today relative to the trend that we were following before COVID. Imagine COVID had not happened. Where we would be today in 2022 compared to where we are today. Now, I'm going first to show you the same picture for the global financial crisis. So now the horizontal line is the trend that we were following before the global financial crisis. You see the years 2007, the crisis hits, and you see us deviating from that trend year after year. So 6 years after the crisis had started, we were really far from that trend. In fact, we never caught back with that trend. We never caught up with the trend that we had before. So there was a recovery, growth came back, but it didn't come back with the strength that allowed us to go back to that trend. Now, let's see what has happened in the current crisis or the COVID crisis, a very different picture. Here you have all the economies going really fast back to the trend. Now, the ones that are really surprising are the advanced economies, which by 2022, by this year, they're likely to be above that trend. The way you read that number, it says, imagine COVID had not happened, we would be in a worse place than what we are today. That's really surprising. That is not just a regular recovery, that's a recovery which is the fastest recovery we probably have seen on record. Now, as you go down my list, you can see emerging markets are not doing as well, in particular if you exclude China. But if you compare to my previous slide, they're still doing quite well compared to a regular crisis. Now, let me emphasize this even more by picking a country where this is even more extreme. Let's go to the US. So I said advanced economies have done well. The US has done even better within that block of countries. I borrowed this picture from the Financial Times, as you can see from the color. You have the 2008 crisis. This is consumption, by the way, it's not GDP. You can see consumption dropping in 2008, never catching up with the previous crisis, never. It doesn't matter how many years you wait. Now look at the pandemic crisis. You can see a fast drop and then a really fast recovery that takes us back to where we were without the COVID crisis. Now that is very, very unusual. And it's so unusual that I cannot think of another crisis that looks like that. Now, let me emphasize this with a couple of other insights from why is it that this was like this. Obviously, policies matter. This is something that we discussed a year ago as well, for those of you who were here with us. Fiscal policy matter, and in particular in the US, fiscal policy was very aggressive. So let's compare the Euro area and the US. The blue line is the consumption, that in both cases fell, of course, as a result of the crisis. But the interesting line is the green line. The green line is the disposable income of households, so income after taxes. Now, in the Euro area, you see a flat line, which is not bad. It says fiscal policy was supportive, so the average income did not fall. In the US, you see something which is once again very unique. The fiscal support was so large that, in fact, disposable income was higher for households, in particular because of the two peaks that you see, which are associated to the two large stimulus packages that were introduced in the US. That is a very aggressive fiscal policy, and you can see a lot more aggressive in the US than in the Euro area. Now, with such aggressive fiscal policy, with such increase in income, you should expect a large increase in demand. Let me show you another picture, which is going to be similar to the others, but it contains a slightly different variable. These are retail and food services sales. So this will give you a sense of how strong demand is, and it's measured in real terms, which means inflation is removed, so we don't confuse prices with actual demand. Now, you can see the data. If I do one of those trends, you can see how high this number has been for the last month. It has been clearly above that trend, not just for a month, for several months. What you need to see here is that we are moving way more goods than what we would have moved without the crisis. When we say the supply chain is broken, it's not working, you have to be careful with that sentence, because we are doing way more than what we ever did before. Now, there is a limit. We cannot do an infinite amount of moving goods across ports or moving goods across countries. So obviously, we're going to talk about bottlenecks in a second. But what I want you to understand is how well the economic engine has worked to deliver things that look as spectacular as this. Some of these goods, of course, are not going to be produced in the US. Some of this demand is going to be spilling over to other countries. So other countries are going to see the benefits of this large demand as well. Now, let me now mention one thing. a lot of this demand has been uneven distributed across sectors. And that's a very important message. And that's something that maybe we did not calibrate well a year ago when we were thinking about the recovery. For example, if you do the picture I'm doing all the time, but only about services, so consumer spending on services, we're doing well. That looks like a great recovery, but we're not going above the trend at all. If I do durables, now you have something which just looks spectacular because we are so much higher than that trend. If you look at the numbers, we're talking about a percentage increase relative to trend, which is really, really large. Again, here we're talking about demand growing at a pace, which is very unusual by the standards of any recovery. Now, the moment you see those pictures, hopefully you start seeing somewhere in the system, you're going to hit some bottlenecks. There's no economic engine that can just restart from a crisis like COVID and deliver all those goods without any hiccups. Now, here we get inflation. Now, I still don't want to panic about inflation. That's going to be my message for today. First, because of the context, which is if you go back in time, we saw massive inflation in the 1970s, which are not here, but you see the 1980s, the 1990s. We saw massive inflation around the world, in particular in emerging markets, but also advanced. Now, we kill inflation for 20 years. Now, if you look closely at the end, I have sort of a forecast for 2022. Inflation is sort of moving up a little bit, but this is nothing compared to some of the episodes of high inflation the world has seen. So be careful with the context. We're not talking about those episodes. We're talking about something which is a lot smaller. Now, of course, if I zoom, things are going to become bigger. So let's zoom in particular in the US. Inflation has shot up to levels which are a lot higher than the target of the central bank, which is 2%. Now, this is the country where we've seen the biggest increase in demand. So it is the country, in particular among advanced economies, where we see the biggest increase in inflation. Now, which sectors are responsible for this inflation? Those where demand is growing the fastest. Here's another picture, which is very unusual. This is not your regular inflation. Here are inflation rates in the service sector, where, as I've shown you, demand has not been that strong. Here is inflation rates in the durable sector, durable goods sector, where inflation have reached levels which are close to or around 10%. Now you can see durable goods traditionally have negative inflation. So this is really unusual. This is not a typical increase in inflation. You can see here once again the emphasis on these structural differences between COVID and any other crisis, the increase in demand, in particular in some sectors, hitting inflation really fast. Now, if I compare to other countries, you're going to see what you would expect. The US is ahead of other advanced economies because the increase in demand has been faster. The fiscal policy support was faster. So if I measure inflation, and I'm going to exclude for this picture things like energy, so we call it core inflation, goods which are less volatile. You can see in the US the spike at the end, which is similar to the previous one. But now if I compare to the euro area, you don't see the same thing. In fact, in the euro area, I would argue that what I see at the end is very much welcome. It's not that I worry about that number, it's that I really welcome that number because the European Central Bank has been under delivering inflation. They're supposed to hit 2% on average, and clearly they were below for many, many years. So a couple of years above 2 or a few years above 2 is just going to be sort of catching up with everything that we did not deliver earlier. Now, let me say a word about emerging markets. Emerging markets are a little bit all over the place when it comes to inflation. If I go to China, you don't see a big trend. You see a little bit of an increase at the end, but there's nothing compared to similar episodes over the last years. If I go to Brazil, it's different. In Brazil, I do see more of a bigger impact. In fact, inflation is close to 10. Now, of course, 10% in Brazil is not that unusual, although it is high by recent standards. We saw 10% around 2015, and we saw even higher around 2002. Now, that's going to be the reality of emerging markets. In some emerging markets, inflation tends to be higher. It tends to be more volatile because the central bank has less credibility. Inflation is less anchored around low numbers. So I would expect a few emerging markets falling into dynamics that are going to look very similar to Brazil. Now, let me do a quick recap before we run through a few questions. Fastest recovery ever, in particular in the US, but also in advanced economies and even emerging markets, and even recovery goods a lot faster than services for obvious reasons because of the type of crisis we went through, at a time where we restarting an engine that had to be stopped, obviously in 2020 because of the crisis, bottlenecks in particular sectors, inflation, which is very small compared to inflation of the high inflation periods decades ago, but inflation that central banks are going to need to deal with it, and they face an unusual situation because this is not your typical inflation, this is not your typical recovery. Now, let me just pick a couple of questions. Chris is going to help me pick those questions, and then I'll tell you a few more things about central banks.
Thanks, Antonio, and thanks to the audience for all the questions coming through. There's a few here that I'll try and group together just so we can answer as many as we can. So there's one here, Antonio, just about, whether do you see pent-up demand waiting to burst, or will we be looking at lower consumption going forwards? And how do you think this ties into, supply chain bottlenecks and these sort of issues?
I mean, I think a lot of the dynamics that I've shown you in my previous pictures, they're slowing down. They're not going away. So this is not that demand is about to fall and we're going to go back to normal in the next quarter. But there's a few things that are happening. You don't have a fiscal impulse anymore. In fact, fiscal policy in the US is going to start going backwards now, because relative to last year, it's going to be contractionary. Because now we're going to start obviously comparing to last year, because we talk about growth rates and we realize that fiscal policy is going backwards, not forward. The other thing that is changing is when it comes to supply chains. Now, supply chains is a little bit of a mystery. It reminds me in the previous crisis, in the global financial crisis, when we all had to learn about mortgage-backed securities, and we all had to figure out how much risk there is in those assets. Same with supply chain. All of us had to learn a little bit more about supply chain. It's hard to get hard data that says this is the current state of the supply chain. But if you look at prices, if you look at other indicators, which are the best quantitative indicators of supply chain, things are getting better. Again, better doesn't mean that we're done, that everything is fine, because demand remains strong. But if you look at the direction in which bottlenecks should move and inflation should move, it should be downwards. Now, there's going to be for sure persistence. Inflation is not going to jump back to 2 over a couple of months, but that persistence at a minimum is pointing in a direction towards the target of the central banks.
Great, thanks. And I'm going to go to the most upvoted question we've got right now, which is, can the US keep printing money endlessly without the USD losing its reserve currency status? And how do you think about what that tipping point might be?
So that's an easy one, because that's something that doesn't worry me much, or doesn't worry me at all. I mean, first, all central banks, I'm going to talk about central banks in a second. All central banks, in particular advanced economies, have been increasing liquidity, what you call in that question, printing money. It's very hard to do a race who has done it the most. Exchange rates have not been affected that much by quantitative easing, which is that increase in liquidity that I just referred to. Exchange rates have been, in fact, very stable over the period where we've seen central bank increasing liquidity massively, and for a good reason, because that increase in liquidity very much matches what the private sector needs. And if you have demand and supply matching, prices should not move, and in this case, it's the price of the currency. Now, over the last weeks or months, what have we seen? We've seen the US dollar getting stronger. Now, why is the US dollar getting stronger? On the margin, not a lot of volatility, but getting stronger. That's the typical pattern you see when a central bank announces that they're going to tighten monetary policy. They're going to increase interest rates. So if the narrative of inflation in the US continues, you're going to see the market possibly expecting higher interest rates in the US. If any, I think that will put the US dollar on an upward trajectory. I don't worry about the US dollar losing the status that they have in the international financial markets, because there's not an obvious competitor. The euro has tried to compete now for 21 years, and it is there, but it's not a competitor at the level of the US. China is not ready, because they're not ready to open up their economy and their financial market. And without that openness, there's no way for your country to be a currency of the world. So in my view, long life to the US dollar, at least for a few more years. Now, let me bring,
yeah.
Go ahead, Antonio. Yeah, I was going to switch to talk a little bit about central banks because I know there's going to be a few questions. And obviously, central banks means talking about interest rates. So let me say a few things about interest rates in the context of what I've said so far. Now, what do we expect to see with interest rates? Of course, central banks are likely to increase interest rates. Now, some central banks have done it already. In fact, some central banks in emerging markets have increased interest rates already quite a lot. The case of Brazil is extreme, where interest rates have gone up to 10% already, but that's also the level of inflation they have. But we've seen it in many countries around the world. If they have not increased interest rates, like Brazil or like the UK last week, they're about to do it. Now, here is the fear. The fear is that it's another taper tantrum, as we saw in 2013, when in particular the US Central Bank, decided to switch from an expansionary policy to a more neutral stance. So that was a time where markets really panicked. And when I say markets, it was the stock market, very volatile. It was currencies of emerging markets, lots of capital flows back and forth. And there was a lot of volatility for a while until we understood, wait, what is this new world with higher interest rates? Now, here is my view to start with, sort of hopefully a reassuring message. We have to be careful about which interest rates we're talking about, because it is likely that central bank interest rates will go up, but this might not be the interest rate you want to look at if you want to think about economic consequences. Now, if I think about not just interest rates, but real interest rates adjusted for inflation, those are the ones that matter for governments. I'm going to talk about those in a second. For companies, those are the ones that matter for the stock market. I'll say a couple of words about the stock market in a second. Now, when you look at real interest rates, which are adjusted for inflation, in particular, if you look at long-term interest rates, because the central bank interest rate is a very short-term interest rate, we can think about it as an overnight interest rate. If you look at 10 years interest rates, real adjusted for inflation, you're going to see a picture which is very different. So let me first remind you, we've seen over the last decades a trend, global trend towards lower real interest rates. In my view, that trend is not going to change in 2022 or in the coming years. Let me first show you the picture. These are 10-year real means adjusted for inflation interest rates. I'm going to pick the US to show you that data. We go back to 1980. Those interest rates used to look like 7. Today, they look somewhat around 0, slightly negative, slightly positive. I do not believe these interest rates are going to move up significantly. And I'll show you in a second, these are the interest rates that matter. Now, what is the central bank interest rate in this story, the one that we are talking about as we look at the news? Well, let me show you the interest rate of the central bank. Now, I shortened the data. So I started in 91. So we look at a shorter period of time so we can see more things clearly. So here's the central bank interest rate. In the US, that is called the federal funds rate in red. Now, what do you see? You see episodes or monetary policy tightening. You see it very clearly starting in 93, 94. You see another one starting in 2004. You see another one around 2017. Now, what is it? The first thing that I want you to see, you can see how the interest rate of the central bank is sort of following the other interest rate. So you have the same downward trend because the central bank at the end of the day had to set an interest rate which is consistent with the fundamental interest rates of the US, which in some sense is a global interest rate. Then you see the spikes, but every time you see a spike, look how flat the blue line is. So the fact that the central bank raises interest rates sometimes by 4 percentage points, it means that the 10-year real interest rate adjusted for inflation barely moves by 1 percentage points, in some cases even less than that. Now, as you look closer to today, you can see these spikes are getting shorter. So they're getting smaller. We're not in the 90s, we're sort of in periods of time, in particular 2017, where the spike in interest rates by the central bank is very small. The change in 10-year interest rates is about half a point or maybe 1 percentage point. Now that is important because as we look at the end of this picture, it is very likely that the red line is about to go up. What really matters for many of the economic dimensions that we care about is what happens to the other line, to the line that is blue. Now, my guess, that line is not going to move that much. Why is it that that matters? It matters, for example, for governments. If I have a government, what matters to me is the real interest rate, the interest rate adjusted for inflation. That gives me a sense of the burden of my debt. Now, governments today, they have seen a large increase in debt on the left-hand side here. But because during the same period of time, during the last 20 years, they've seen a decrease in real interest rates, their interest payments keep going down. So you have more debt, but you pay less interest on that debt. Now, if you look at the end of this picture, that level is the lowest level we've seen for the last 20 years. Now, what happens if the central bank raises interest rates? Remember, they already did in 2015, 2016. You don't see a big change in those years here. You're not going to see it either. Why? Because the 10-year interest rate, in particular, if you adjust for inflation, is not going to look that different. So here is a picture that says, be careful. Be careful. We're going to talk about higher interest rates, how much higher the central bank interest rate will go. It will depend on how fast inflation comes down, for sure. But an interest rate that goes up by 3% on the central bank side does not mean a 3% higher real interest rate for everyone. It's likely to be a much, much, much smaller amount, and is likely to have a very small impact because these numbers are driven by that long-term trend that I don't see changing soon. Now, what if you're an emerging market? I'm showing you the US. Is this story valid for an emerging market? Yes and no. Interest rates have been coming down globally. The picture that I've shown you for the US, if I did for Brazil, it would look very similar. If I do it for South Africa, it looks very similar. If I do it for Singapore, it will look very similar. So the long-term trends are similar, but if you're an emerging market, the central bank is likely to be less credible. There's going to be a risk premium, and there's going to be this question mark. Do I trust you? Do I trust you as a country? And if I don't trust you, the risk premium might increase dramatically, and a lot of the things I just said might look a lot bigger. Now, that is possible. We have past experiences where this has worked really poorly for emerging markets. Sometimes when the US central bank was raising interest rates, for example, in the mid-1990s, we saw many, many countries going into crisis. Mexico went into a crisis. Asia went into the Asian crisis. Now, here's the optimistic take on that. We are not in the 1990s for many reasons. Interest rates are lower, so we start at a lower set of pressure. Very few countries have fixed exchange rates. That is good, because what would happen in Mexico in those years or in Asia was partly driven by fixed exchange rates. And more importantly, a lot of these countries have built a much stronger fundamentals from a macroeconomic point of view. That makes a big difference when you think about the risk, their exposure to a crisis. For example, if you look at foreign reserves, which is that drawer of liquidity in foreign currency that countries have in case that they face any capital outflow, they have increased dramatically over the last years. You can look at the 90s, 3 emerging markets, one in Asia, Thailand, one in Latin America, Brazil, one in Africa, South Africa. Numbers are tiny. And then you see an explosion in foreign reserves, in particular in Brazil or Thailand. Of course, those are also bigger economies than South Africa. But now you see numbers which are really large by the size of those economies. In addition, inflation is much lower. Central banks are more credible. So a set of fundamentals that are really a lot better than in the decades where we saw large number of crises. Now, I'm not saying all emerging markets are fine. As we speak, there are many emerging markets that are getting to the edge, and there will be a few more over the next years. That's what I expect. If you look at Ghana as we speak, is heading for a crisis. Interest rates are spiking. The government debt is high, and you can see a typical example of an emerging markets crisis. I just do not see a massive number of countries getting into a crisis, but I do see a lot more pressure in an emerging market than what I see in a country which is advanced. Now, let me bring the stock market. I always like to show a picture, which is my favorite indicator of whether the stock market is overvalued, is cheap, is expensive. And for those of you who've seen me doing this, what I do is I look at the price of the stocks, I look at the earnings, and I also look at interest rates, because it is fundamental when you look at the stock market to understand what the interest rate is. The most basic finance intuition says if you value a stock and you use a discount rate, which is lower, the price of a stock is going to go up. So you need to combine all those elements, the price of the stock, the earnings, and the interest rate to come up with a sense of the valuation of the stock market. Now, the way you're going to read this number, this is going to be a bubble indicator. So I built it in a way that if you go up, it means you're in a bubble territory, the market is overvalued. If you go down, you're in a bargain, the market is really cheap. Now, what is the market today? This is the US stock market, by the way, the S&P 500. So it is sort of, I'm going to call it an average market. Let me put a horizontal line there to pretend that's the average. It doesn't look very expensive. It doesn't look very cheap. You want to look at an expensive market, you have to go to the year 2000 or the year 2006. Those were very expensive markets compared to the interest rate, which is the right comparison. You want to look for a bargain, go to 2008 or 9, go to 2012. Those were very cheap markets. Now, if you look at today, it just sort of looks average. Now, how can it be if the market did really well last year? Once again, interest rates, in particular, real interest rates, came down last year. So when you do the math and you put the two together, the market has a similar valuation than a year ago. Similar. What if interest rates go up? Would this calculation change? It will, but you have to give me a number. By how much will real interest rate increase over the next year? Now, my expectation is that real interest rates, in particular, real long-term interest rates, are not going to increase by much. If you want to move it by half a point or a point, just move that line down by about, up by about half a point or a point. It would look still fairly average. It might get close to the 2018 valuation, 2017, but it wouldn't look anything like 2006 or 1999. Now, of course, the market can react. It can panic to central banks acting. So I don't want to make a prediction, and you don't need to check a year from now. But fundamentally, I still see a market which is sort of reasonably priced compared to the fundamentals, which are earnings and, of course, the interest rate. Now, let me open up a short discussion. I'm almost to the end of my presentation on maybe some asset prices are not as fairly priced as others, in particular, those associated to technology. So we might be looking at the market from different angles. You might look at a particular company and you say, look, this doesn't look reasonable to me. This looks like a big bubble. Now here I'm using the word meta in front of asset prices. Probably you all understand why. The company Meta or Facebook has seen their stock price falling dramatically over the last days or weeks. Now there's a lot of noise about sort of excesses in technology, optimism that is not guaranteed. Now, here is my view, sort of a mixed view. I don't think we're in the 1990s. The 1990s were the biggest bubble I can see in the stock market globally, not just in the US. At the same time, I do feel uncomfortable sometimes when I hear people describing the business models behind some of these projects or companies. From my taste, there are too many buzzwords when people describe those episodes. Now, what do I mean by too many buzzwords? How can it be that we spend so much time selling a business model that is entirely based on the specific format of a database we use? That just does not sound right to me. How can it be that there's so many businesses which are highly centralized and they sell you the hypothesis that if the world is decentralized, everything will be better? That just sounds a little bit contradictory. How can it be that every time you challenge someone and say, wait, that doesn't sound right, the people always will say, well, everything is like the internet. No one could understand it at the beginning, but then it turned out very well. Now, that to me is not a great logic. And then how can it be that we are so obsessed with things that I'm going to call status-based consumption? And obviously NFTs is a good example of that. I mean, is that the best we can do with technology? Now, if I think about all the potential things we need to do with technology, a lot of these things in these question marks they just don't cut it. That's not, I think, where the focus of our innovation or our technology should be. So there I'm concerned. I don't think this shows up as much in the stock market. It's not purely about overvaluation of all the stocks, but a lot of these things have a little bit of the flavor of a bubble episode where we're too excited about things that might not pay off, certainly not all of them. Now, I'll just say this as a joke. I'm done with Web3, so I'm ready for Web4. Maybe it will be better than this. And here is my nice example of why I'm done with Web3. Of course, I put the INSEAD logo on that hat to create, I don't know, my new NFT. Obviously, there's probably no copyright on this thing, so I'll just cut and paste. Now, let me talk about things which are potential risks for the coming year. Again, hopefully you've heard I tried to be semi-optimistic about the current year, in some cases more than semi-optimistic. So I think we are in a year of solidifying the recovery that we saw in 2021. But I don't want to deny that there are risks that in some sense are larger than a year ago. A year ago, I saw a path of recovery. Of course, we still had the variant discussion a year ago, and health outcomes today is not as bad as it used to be. But here are the risks that I see, and some are not small. Even if I think that central banks are in a good position to normalize and bring inflation down, I expect a lot of noise around it. And by noise, I mean I expect markets to be volatile. I expect tensions sometimes when it comes to wage negotiations, to settings of prices, and that might lead to political volatility or political uncertainty in some countries. Raising interest rates is not easy, even if we're not going to raise them too much. So I do expect a lot of noise. And in some countries in particular where the central bank has less credibility, this could be an issue. I'm a little bit worried about policies in some countries in this region of the world where I am, in particular countries like China with the zero COVID policy. I think these potentially could keep their economies at a speed which is not quite the speed that the world needs. Again, if there was a spike in COVID cases in a country like China, could we see a little bit of another lockdown in China? That's a possibility, and that will for sure affect the world economy, not just Asia. And there's obviously not many countries in that position, but China matters because it's either the largest or the second largest market in the world, and certainly is a big part of all the discussions we're having on supply chain issues. What else worries me? Geopolitical risk. Some of these risks are always there. I think the tension between China and the US is not going to go away. It's going to stay there. It's probably going to get bigger as time passes. But then we have other things which are quite unique today. Ukraine, again, an issue that I wish it wasn't there in front of us. And I think that could derail the type of recovery I'm seeing in 2022. Cross fingers that it doesn't happen. And then here is my last concern, which is going to be a little bit philosophical, more than maybe real for some of you. If you look at the US, there's something interesting, which is every time unemployment goes down to very low levels, which is what it is today. Unemployment in the US today is almost as low as it's ever been. You immediately get a recession. In fact, if you are into the business of predicting recessions, I can guarantee you low unemployment is one of the best predictors of US recessions. In fact, let me tell you a story that I very much enjoy over the last years. In 2019, I wrote an article. Let me give you a picture of the title of that article. That was called The 2020 US Recession. I wrote that in March 2019. So I was predicting a recession in 2020. Now, this was one of my best predictions ever because there was a recession in 2020. Now, of course, I did not really predict the crisis because I did not predict the pandemic, but I was using data to show how in the US, whenever unemployment goes down, it typically is followed by a recession over a short period of time. Now, that's where we are today. Unemployment is down. We have sort of done most of the recovery, in particular in the US. Another question is, are we going to see an expansion phase, which is going to be unique? One where we start with a fairly low unemployment rate and it stays low for several years. That will be the first time that we see in the US. Do I have a strong reason to say that's impossible? No, that's possible. But I know what the previous cycles say. The previous cycle says we've never seen any expansion where the unemployment rate stayed low for such a long period of time. So this is in my mind because it happened to work in 2019, even if for the wrong reason, and it happens to work in every previous cycle. In my mind, there's a question: as we exhaust the recovery, could it be that we are heading immediately into a recession? Again, question mark, together with this other risk. I think we need to keep an eye on all of them. Hopefully, none of these risks will materialize. And hopefully, I'll see you again a year from now when we do another webinar, and we'll check whether any of these predictions turn out to be right. Now, I wanted to keep the last 15 minutes of the session for Q&A. So Chris is going to be back picking some of your questions. Keep writing questions or upvoting, and we'll do our best to go through some of them.
Thanks, Antonio. I wanted to pick up in particular on China. So, I mean, we've got potentially China closed for the best part of 2022. And after that, the conundrum is how to open and when. Do we see potentially a continuation of a decreasing growth rate that we've seen, even before COVID?
Yeah, I mean, China is a story which is a complex one for many reasons. Before COVID, we saw sort of a trend towards lower growth. Obviously, some of that was caused by the fact that China is getting richer. So lower growth is a more natural state for a country like China. But at the same time, lower growth for a country that is used to very, very fast growth rates started putting some constraints and challenges. In particular, when things are imbalanced, and in China, there was a few imbalances, it's sort of easy to get out of imbalances when you're growing at 10%. When you're growing at 5, it's harder. When you're growing at 3, it's harder. So the tensions that we've seen in China on the real estate market, I think partly are coming from the fact that we don't have the same growth rate we used to have. The difficulty that China has to rebalance the economy, which means reducing investment and increasing consumption, is partially related to the fact that now they're not growing that fast. So it's very hard for the government to switch off the investment engine. It's very hard, because then they fear that growth will be smaller. Now, the current policy with COVID puts them in an even more difficult situation, because certain sectors have not recovered in China, because there's still obviously the restrictions and the fear that there will be a lockdown if there was a COVID explosion. So I think they're dealing with an economy which is hard to manage, a lot harder than in the past. The lower growth rate makes things more difficult. At the same time, China, from a political point of view, is trying to establish themselves as a superpower with a lot of influence on the rest of the world. They cannot afford to have a crisis now. And I don't know if you've seen some of the comments that come from the US this year. They say this year, the US grew faster than China. I think I saw a tweet by Biden about this, President Biden. So happy that for the first time in, of course, I don't know how many decades, the US is growing faster than China. Of course, that comparison makes no sense because the US growth number is just so unusual. But from a political point of view, China cannot allow to look weak in front of others. So I think it's going to be, again, challenging for policymakers in China to see what happens this year and the next, in particular, seeing the strong growth of the other countries.
Do you see, if we look at the Great Resignation, I mean, that's been one trend that's been upsetting, labor markets. Is that going to be calming down, do you think?
Yeah, that's a good question. And that's another phenomenon that I think all of us are trying to understand because it caught us a little bit by surprise. I think we need to take a step back and again understand we just went through a crisis that we knew was going to be unique. This was not a financial crisis. It was a crisis caused by a health event. And many of us have our own personal stories, and we've seen dramatic outcomes in many countries. It is not surprising that we see some people being very reluctant to come back to the labor market, in particular for health reasons. Some people cannot come back to the labor market because their kids are still at home and they need to stay at home to take care of their kids. And then you have also people who, because of that massive fiscal support from the government, they've really looked at their jobs and they say, look, I need something better. I have now the slack to buy myself some time and look for something better. And that happens at a moment where the labor market is really running very hot. So then I see options. So we've seen these massive shifts, what we call the Great Resignation, people quitting, people finding jobs at a rate which is once again something that we've never seen. Now, some of these trends, people see them as structural. For example, people say, I don't know, people who are over 55 years old, they're retiring earlier, they're not coming back. Now, I've been always skeptical about that statement because we've said that in the past and then people come back. People come back when they run out of money in some cases. People come back when the labor market is even stronger and they see opportunities, or people come back when their support from the government stops. So I think we're going to see some of it. And in fact, the numbers that were released last week, the latest numbers from the US labor market, you already see a reversal of what people call the Great Resignation. So I'm optimistic. I think there's been some disruptions that might be structural, but I think a few of these things will go away.
And there's one question here, just coming back to something you mentioned earlier. Can you please explain the intuition behind why low unemployment might lead to recessions in the US?
So I don't have a great story. That's why I say it's a little bit more of a philosophical risk. It's a statistical statement. So if you look at the US, whenever unemployment reaches a low point, so unemployment is coming down, it reaches a low point, statistically speaking, you're going to see a recession within a short period of time. Now, if you ask me what is going on, I could imagine things like this. As unemployment goes down, the economy overheats. People get a little bit too optimistic. We create imbalances. Those imbalances lead to a risk that then leads to a recession. So something like this could be going on. But then if that's the story, it's not the unemployment rate. The imbalances are causing the recession. So then it's a much harder question to answer. Do we see enough imbalances today to cause a recession? I don't see them. I see the risk. I put them up there. I don't see them. So I'm optimistic that that statistical fact, which is there, and I've written about it myself, might not work this time. It might be that this time we're going to see a fairly long period of time with low unemployment, which is great, because that's what you want. You want an expansion where the labor market is at full employment and it stays at full employment for a long period of time. That's an ideal outcome.
Thank you. And let's one question here about energy prices and the impact of the energy transition moving forwards.
I mean, that's a big question. I don't think it's a 2022 question, but it's a question for the long run. I'm not talking, of course, about energy transition today. I haven't said anything. We haven't talked about climate change. I mean, those are trends that are there. They're real. They're happening in some cases faster than what we thought. There's many countries and regions where regulation is changing, and this energy transition will be imposed on us, whether we want it or not. Now, what do we know? We know that this is going to be costly. We need resources. The resources can be seen as you're going to pay more for the same energy, or we're going to have to invest to create energies which are the right energies for the future. And in both cases, we need sort of to realign the economy. Probably means more investment, less consumption, probably means paying more for certain sources of energy. And in some cases, that comes to an understanding that maybe we'll be poorer because we need to pay more for the same energy, or maybe we need to sacrifice consumption for investment to be in a world that we want to be, where we sort of somehow fight climate change. Again, what I just said is not easy because it requires a lot of political leadership, social understanding, and some of these issues can be complex from an economic point of view. We just went through the experience of going through a pandemic. The interaction between government, society, scientists has not been the best, at least that's my reading. So I'm a little bit worried that when we deal with things with climate change, we're going to fall into similar traps, that the interaction between governments, the private sector, scientists, experts is not going to be the most productive, but let's hope that I'm wrong.
Great. And there's a few questions here just around the Ukraine-Russia issue. So some people have asked about the impact on markets and on energy prices in particular for, potential conflict between Ukraine and Russia.
I mean, I think there are two dimensions. One that I'm not sure I'm going to be able to do a great forecast, which is from a political point of view. If Russia were to invade Ukraine, what would be the response of sort of the countries like Europe or the US? And I'm not sure what it would be. I think what they're saying today is there's going to be massive sanctions, but no more than that. If that's where we stay, I think both the sanctions and the likely increase in energy prices, and in some cases the shortage of energy coming to some countries, in particular Europe, will be highly disruptive. I think for sure we would get sort of growth slowing down to a halt when that happens. Markets for sure will panic. Now, I think there is the capabilities to sort of come back, and partly because of the summer is there, the summer energy consumption will go down. So you will see a little bit of a rebound after that, but I think the impact will be fairly large on the type of forecast or scenarios that I'm putting for 2022, and that impact will be very large the moment it starts. Yeah.
Okay, and turning attention a little bit towards NFTs and crypto, we've got one question on, will they become a significant or a serious part of a portfolio allocation?
I mean, I personally don't think so, but let me be clear what I mean by that. I still don't see any of those two things as being fundamental to financial markets, fundamental in the case of NFT. I'm not sure. It could be fundamental to artists, fundamental to the way we exchange digital assets. I don't see them as such. Now, of course, there's a lot of attention. Of course, there's a large volume of funds that have been directed towards these markets. Again, when I look at NFTs, I see in many cases what I call a status-based consumption. I want to own this particular image. Of course, how much do I own it? I don't want to go to that question, but I somehow own it. I have it in some community where people can see that I'm the owner. Now, people can enjoy that. And I might not enjoy it personally, but if other people enjoy it, that's great. I just don't see that a large part of the way we think about our consumption, or the large part of the way we think about the financial system. Now, cryptocurrencies, decentralized finance, and many other similar activities are attracting a lot of funds. I still don't see them as fundamentally challenging the traditional forms of finance, certainly not the traditional forms of payment.
And what do you see as the drivers behind the popularity of crypto and NFTs?
I mean, I think like any new technology has happened, every time something is new, it becomes attractive. If I want to understand them, I need to talk to my kids, who are more open than I am to these new technologies. If you play a video game, for those of you who like to play video games, sometimes we are in these video games where we buy a certain, I don't know, a certain jacket, a certain hat. And if you wear that hat, you're sort of cooler than anyone else in that world. So if you live in that digital world, you buy things that are digital, right? Now, I see this in many ways the same way. Now, you need a community. It's not enough to say, I have a record on the blockchain that I own an NFT. I mean, I'm not sure what you do with that. It's very hard to share with others. Now, the type of businesses that are growing very fast, for example, OpenSea, probably some of you know about this, is sort of the platform today where people buy and sell NFTs. Now, that's the real business, is that platform, which is not on the blockchain, is a regular platform, a regular website. Now, there you can buy something and you can show it to others. It's a little bit like the video game story. So again, I can see that logic. I can see it working for some. I just have a hard time saying, and this is going to fundamentally change the world we sell and buy art. I just don't see that. I think this is something different. There is a space for that. It can be very, very successful for some people, but I think that's very different from thinking this is going to change the way we do business in certain sectors, whether it's sports, whether it's art. I just don't see that part.
Thanks, Antonio. And just going back to, we talked earlier about China slowing down. Somebody's asked, Ricardo's asked, could you comment on India and Africa? Will they become the engines of growth that China was in from 1990 to 2010?
I mean, I think India has been in a great trajectory. I think India over the last years have sort of reoriented their economy in a way that maybe they should have done decades ago. The potential is there, the market is there. As long as the policies and the institutions are there, it's a country that is likely to grow at a fast rate for decades. Now, India has never shown growth rates as high as China in its best years. My guess is they won't. But given that China is slowing down, India slowly will become the engine of growth that you see in emerging markets. And the bigger they are, the more their growth rate obviously will affect world growth. Africa is always a complex region because you have lots of countries. Unfortunately, what you're seeing today is after some good experiences in the last decade or 15 years, so we've seen some countries doing really well in Africa. Now that things are less favorable to some of these markets, I think you see more of the volatility again. Now, volatility might not be the end of the world. We're going to restore growth in some of these countries for sure. But to be a country like China, you need to be an engine of growth, which is persistent. I mean, that's what is incredible about China, how fast it grew for how many years. Showing 10 years of great growth and then sort of stagnating for another 10 years is not going to cut it. So they will be there. I mean, Africa will be there. The potential, obviously, the demographic potential is enormous, but I'm not see them being able to replace the type of growth that China generated over the last decades either.
Very good. And maybe just to wrap up, do you see, do you have any investment tips towards, which particular asset classes would you be recommending towards the 2022?
I don't give investment tips. I'll just say a few words. Again, when I look at big classes of investment, I mean, it's challenging. It's a challenging world, 2022. Why? Because if interest rates go up, central bank interest rates and others, even if by a small amount, yeah, if you invest in bonds, they might not do well because likely they're going to get weaker as interest rates go up. The stock market, even if I still see it as fairly well priced, to me is likely to be very volatile. And there could be a narrative that is built into the stock market through the year as interest rates go up, that this is not a great year. And you see a stock market which is flat or maybe decreases over the whole year of 2022. But I think that's the reality of investment. Again, if you're looking for an investment return like the last years, every year, I'm not sure you can find it. Obviously, you can try your luck and gamble on markets which are a lot more volatile, but that's not my expertise, so I will not go there.
Thanks, Antonio. And just one more. Kevin asks if you're going to continue your daily blog.
I'm not. I mean, that's a complex question. I stopped writing blogs because the world sort of abandoned blogs and everyone started going to Twitter, and that's the way communications happen. So I switched there. So I'm there in Twitter. Now many people are switching back to blogs, and I'm rethinking whether I should do that myself. But it's a complex world where people find different communities, and it's sometimes hard to keep up where the communities are. I've been sort of moving around, and I'll try to stay wherever the community is. So we'll see. Maybe I will start doing it again.
Antonio, well, thank you very much indeed for your time today. And thanks to the audience for all of the great questions.
Thank you.
So if you'd like to stay connected with INSEAD, you can find us on LinkedIn. Just look for Lifelong Learning, and you will find there lots of webinars. You can also check this out on our website, insead.edu/alumni/lifelong-learning. Share your feedback with us as well with the survey that's coming to you soon. And I'll leave it there. Thank you very much indeed, and goodbye.
Thank you, everyone. Goodbye.